Think about this for a second. What would it be like to trade, not with a couple $1,000 of your own cash, but with hundreds of thousands of someone else's? Well, that's the whole appeal of a prop firm, right? They front the capital, you bring the talent. But here's the catch, and trust me, it's a big one. Your number one job isn't about making a killing overnight. It's about protecting their money.
So let me just ask you straight up, could you really handle a $200,000 account? I mean, the profits, they sound incredible, but the potential losses are just as massive. This isn't just about finding a winning strategy. It's a test of pure discipline.
Okay, let's get into it. The moment it's not your capital on the line, the entire game changes. It shifts from just trying to grow an account to an intense focus on managing risk. So here's what we're going to do. We'll break down the 5 major risks, we'll look at the toolkit you need to handle them, we'll see how these firms come up with their rules, and finally, we'll learn from some giants who got it wrong so you don't make the same mistakes.
All right, first up, you have to understand the battlefield. If you want to make it as a funded trader, you absolutely have to become a master at spotting and navigating the 5 fundamental risks of trading.
And here they are: market, liquidity, credit, operational, and systemic risk. You can think of these as different opponents in a video game. Some are out in the open, others are hiding in the shadows. But any single one of them can be a game over for your funded account if you're not ready for it. Let's kick things off with market risk. This is the big one. It's the risk you just can't hide from. It's like the ocean tide. It can lift all the boats or it can sink them all. We're talking about huge economic reports, a surprise move from a central bank, or some sudden geopolitical event. You can't control it, but you better respect its power.
And this is what's so important to understand. Market risk isn't just some vague concept. For you, the trader, it's a sudden explosion in volatility. It's an unexpected interest rate hike that turns a winner into a loser. Or it's a currency swinging against you and wiping out your gains. Any one of these can smash through a prop firm's daily loss limit in a matter of minutes.
Next up, we've got liquidity risk. And let me tell you, this is the trader's worst nightmare. You're trapped. You see a trade moving against you. You hit the button to get out, but nothing happens. There aren't enough buyers. Your stop loss gets blown past, and what should have been a small, manageable loss becomes a massive one. For a prop firm, this is a huge red flag because it shows you can't manage your exits.
Now, the other 3 risks here are just as critical. Credit risk is basically asking, can I trust the platform I'm using? What if the broker the firm uses goes down? Then there's operational risk. This one's all on you. It's the classic fat finger trade where you accidentally add an extra 0 and blow up the account. And systemic risk? Well, that's the big one. The 2008-style financial crisis where the entire system feels like it's about to collapse.
So, we've identified the threats. Now, let's talk about your weapons. Having a risk management toolkit isn't just a nice-to-have for a funded trader. It is the absolute foundation of your entire career. And this right here perfectly shows the main tool prop firms give you: leverage. Look at the left. With your own $1,000, a 10% gain is $100. Not bad. But look at the right. Using the firm's capital with 10-to-1 leverage, that exact same move nets you $1,000. That's the power. But you have to remember, this is a double-edged sword. A 10% loss is also magnified by 10, and that is exactly how accounts get destroyed so quickly.
This whole process is so important to grasp. You're using the firm's money as collateral. But the most critical step here is number 5, the margin call. You see, for a regular retail trader, a margin call is a warning shot, a notice to add more funds. For a funded trader, it's game over. There is no adding more money. A margin call means you're liquidated, and your journey with that prop firm is done.
So how do you prevent that from ever happening? You master these tools. Position sizing is your first line of defense, deciding exactly how much you're willing to lose on any one trade. Stop losses? That's your eject button. It's not negotiable. Diversification keeps you from betting the farm on a single idea. And hedging is a more advanced way to protect your downside. You master these, and you're already way ahead of the curve.
Okay, now to really make it in this world, you have to start thinking like the firm that's funding you. To play their game, you have to understand their rules. And their rules are all built on one core idea: measuring risk with numbers.
And this is their number one tool, value at risk, or VAR. I know it sounds super technical, but it's actually a pretty simple concept. It just answers the question, looking at the past, what's the absolute most we can expect to lose tomorrow with, say, 95% certainty? That single number is what drives the rules you have to trade by.
Now, firms can figure out VAR in a few different ways. The historical method literally just looks at what happened in the past. The variance-covariance method uses a more standard statistical model. And the Monte Carlo method is the most intense. It runs thousands of random possibilities. Honestly, the method they use doesn't matter to you as much as the final number it spits out, because that number sets your boundaries.
So let's make this real. Using one of those methods, a firm might calculate that on a $100,000 account, their 95% one-day VAR is $2,575. Now that number isn't just some academic exercise. It directly becomes a rule. A rule like your maximum daily loss limit is $2,500. You breach that, even by $1, and you're done.
And this is the other unbreakable rule: maximum drawdown. This isn't about just one day. This is about the total amount your account is allowed to drop from its highest point ever. So let's say you take a $200K account and run it up to $210K. That $210K is your new high watermark. If the firm has a 10% max drawdown rule on your starting balance, your do not cross line is $180K. Some firms even use a trailing drawdown, which is even tougher to manage. It is the ultimate line in the sand.
Look, theory is one thing, but the most powerful lessons usually come from watching things go horribly wrong. So let's look at what happens when risk management completely breaks down on a massive scale. Just take the collapse of Archegos in 2021. This is like a prop firm trader's worst nightmare played out on a global stage. What did they do? They used insane amounts of leverage, and they had almost zero diversification, just a few massive bets on a handful of stocks. When one of those stocks went south, the margin call started rolling in, and the entire house of cards came crashing down, costing huge banks billions of dollars.
Or think about the London whale incident over at JP Morgan. A single trader managed to lose over $6 billion. And the lesson from that? A total failure of internal controls. For you, as a funded trader, your written trading plan is your internal control system. If you don't have one and don't follow it, then you become your own biggest risk.
And that brings us to the final, and honestly, the most important piece of this whole puzzle. You can understand all the risks, you can know all the tools, but none of it matters without the right mindset and a rock-solid plan.
So here's the bottom line. You need to build your own professional-grade risk management plan. And I'm not talking about some vague idea in your head. I mean a written document. What's my maximum risk per trade? What are my exact rules for getting in and getting out? How am I going to handle a losing streak? You have to define all of this before you're in a trade and the market's emotions start messing with your head.
And that's really what it all boils down to. The prop firm, they give you the capital and the rules. The market gives you the opportunities. But whether you succeed or fail ultimately rests on this one simple question. You can write the perfect plan, but is your discipline strong enough to actually follow it every single day on every single trade? That is the real challenge. That's the journey of the funded trader.